We're going to continue our discussion on Chapter 2 with the standard deduction. The standard deduction for 2018 has been increased significantly over the amounts for 2017 due to the recent tax law changes and the disappearance of the personal exemptions. The standard deduction for 2018 for a single taxpayer is going to be $12,000. For married filing jointly taxpayers, $24,000. Married filing separately will be $12,000. Head of household filing status would be $18,000, and qualifying widower would be $24,000. In addition to the standard deductions in the last slide, there are additional standard deductions for taxpayers that are 65 or older or blind. If the taxpayer is filing as either single or head of household, the taxpayer would receive an additional standard deduction of $1,600. If the taxpayer is filing as married filing jointly, married filing separately, or qualifying widow or widower, they would receive an additional standard deduction of $1,300. If we have a taxpayer that is claimed as a dependent by another taxpayer, the standard deduction is going to be limited to the hire of either $1,050 or the taxpayer's earned income plus $350. So this comes into play a lot if you have an older child or college student that is also working and their parents are claiming them as a dependent and they have some earned income. So if we have a college student that earned $4,000 over the summer, their standard deduction would be that $4,000 as their earned income plus $350. So their standard deduction on that tax return would be $4,350. Okay, so let's take a look at another example. What amount would represent the standard deduction for a taxpayer who is 43 years old and claiming the head of household status? So if we go back up to our prior slide, we'll see that the standard deduction for head of household is $18,000. So that would be what the standard deduction would be for him in the first question. In the second question, what amount represents the standard deduction if the above taxpayer was blind? So if the taxpayer is blind, then they would qualify for the additional standard deduction, which head of household is $1,600. So we would add that to the prior standard deduction of $18,000. So the taxpayer's total standard deduction would be $19,600. So next we're going to talk about how tax liability is calculated. We discussed prior that the tax liability is going to be computed either using the tax tables or the tax rate schedules if the taxable income is over $100,000. We will also have tax payments and credits that reduce the tax liability. These include withholdings that are sent in by the employer and any estimated payments that are sent to the IRS from the taxpayer. Tax credits are either going to be non-refundable or refundable, and we're going to discuss those in greater detail in Chapter 9. At the end of the tax return, we'll be calculating either the tax refund or the amount that's due with the return. If there is an excess payment in taxes, that's going to result in a refund back to the taxpayer. And if there is an amount due, that is the remaining tax liability that is owed to the IRS. If there is a remaining tax liability that is owed to the IRS that isn't paid by the time that tax return is due, the IRS can charge interest and penalties. The interest rate that the IRS charges is the federal short-term rate, which changes, plus 3 percentage points. So these are some examples of some different rates for recent time periods. The penalties that a taxpayer can incur include the failure to file a return penalty. The penalty for this is 5% per month or fraction of the month, not to exceed 25%. There is also a failure to pay penalty, which is 0.5% per month or fraction of the month, not to receive 25% of the amount that's due with the return. The maximum amount for the failure to file and to pay penalty is 5% per month or fraction of the month, not to exceed 25%, when both of those penalties apply to the same situation or the same return. So if you have a tax return that's not filed and paid, then the IRS is essentially giving you a 0.5 percentage point discount because both of those penalties apply. There is a failure to pay estimated tax penalty, and this would apply if the taxpayer fails to pay during the year either a minimum of 90% of the current tax year's liability or 100% of the prior year's tax liability if the taxpayer's AGI in the prior year is less than $150,000. There's an accuracy-related penalty that the IRS can apply if there's negligence or substantial understatement in the tax return, and this is 20% of the tax that's due. There is also a fraud penalty, and this applies to an understatement of tax that is attributed to fraud. So this is the taxpayer that went in and willingly filed a very false tax return that it would be considered fraud, and the rate for that is 75%. If an erroneous claim for a refund or credit is filed in a tax return, the penalty for that is 20% on the amount that's disallowed. And this erroneous claim for a refund or credit penalty is not applied if there is fraud or the accuracy-related penalty has also been assessed on that return.